Welcome to the Business Talk podcast. I am your host Deepak from India. We are delighted to welcome Dr. Beatrice Michaeli, Associate Professor of Accounting at UCLA Anderson School of Management, as our distinguished guest on today's podcast. Dr. Michaeli became a faculty member at UCLA Anderson in 2014, following the completion of her PhD and MPhil in accounting at Columbia Business School. Her research focuses on developing analytical models in financial reporting, voluntary disclosure, performance measurement, incentives, and contracting. As she explains, I aim to capture the world in a clear, abstract model that enables me to tackle significant practical challenges and offer actionable insights for firms and regulators. Born in Bulgaria to a family of judges and lawyers, Professor Micheli began her career in law, earning advanced degrees, and a shift in interest led her to business, where a teaching opportunity at Interdisciplinary Center, Herzliya, revealed her passion for academia. This inspired her to pursue a doctoral degree, and she has since built a career in research and teaching, saying she wouldn't live her life any other way. At UCLA, she teaches the MBA course on corporate decision making and incentives, where she balances her research on abstract analytical models with practical insights drawn from real world case studies. She also earned an MBA in accounting and finance, as well as an LLM in law from Tel Aviv University, Israel. Her legal studies began in Bulgaria, where she completed both an LLB and an LLM in law at Cyril and Methodius University. In this episode, Dr. Beatrice Michaeli discusses her research from courtrooms to classrooms, a journey into financial truths, exploring how her background in law and white-collar crime prosecution informs her approach to financial reporting, disclosure, and teaching future business leaders. It is my pleasure to now welcome Dr. Beatrice Michaeli to the conversation. Dr. Michaeli, we are truly honored that you have accepted our invitation and delighted to have you with us today.
Thank you very much. I'm very happy to be here and thank you for inviting me.
Thank you. Professor, how did your early experiences in law and prosecuting white-collar crimes shape your perspective on financial reporting and corporate accountability?
Thank you. So my legal experience, even though the studying was long, my experience practical was brief, but I think it was very formative. So those early years taught me that essentially, not only taught me, they fundamentally shaped the way I think about transparency, about reporting. So very often looking at numbers, it taught me that sometimes the numbers that you see, the reporting that companies do, well, they might be very compliant. The facts might follow every regulation, and yet the whole picture might be somewhat misrepresented or create a different. So very different and small decisions, let's say the timing of the disclosure, how you frame it, they can make a big change essentially. So the problem usually is not a number that is missing or something. It is more the framing around it. So all those early experiences made a lasting impression of how I think about tax reporting, financial reporting in general, because those are not ultimately compliance documents. Those are going essentially to tell us the story of a company, the truth that the company says about itself, or the truth that it wants to communicate to the investors. So when I started my journey in academia, I said, okay, this is where one can do. Like my legal experience is more reactive, where we essentially investigate and prosecute after a certain crime has been or harm has been done. Whereas academia essentially opened for me the opportunity to take a different approach, more approach of prevention, where you really try to think about what led to those decisions and prevent it. You can design incentive scheme, you can put all different controls or other optimal solutions that are essentially going to prevent and make the individuals take the right calls when it's really needed. So that's how I see the connection and how it really brings me from one to another, if that
Very
makes sense.
insightful. Yeah. Dr. Michaeli, what lessons from the courtroom have you found most applicable in the classroom when teaching future business leaders?
Yeah, I know it might look very different, but I think the classroom and the courtroom, they really share a lot in common. I would say the biggest lesson is humility. Not humility in that when that humility that you think about modesty, for example. It's rather the humility about realizing that we don't have a lot of control or not all the controls in our hands. So thinking about it, what really brought me is in legal or in litigation, you can prepare impeccably for a case, and then one small fact or that you didn't anticipate and you weren't even aware of, or one witness can essentially append the whole case. So what litigation taught me is about anticipating all those turns around and live with the uncertainty. Be best prepared, but also be prepared that you might be wrong. So that precise humility is at the center of how I teach my classes. So you did mention corporate decision making and incentives, the class that I teach, and it is a twist of managerial accounting with a little bit of more emphasis on incentives. I also teach a financial accounting class, so I'm going to talk about both of them and how they differ. So, my managerial accounting class of corporate decision making and incentives, what we do with the students is think about first about managers who try to find the best information in order to make decisions. So, they're trying to decide what kind of information to collect, what kind of information to request from the information systems or from their employees to be reported to them in order to have the best information to make decisions. Now, ultimately, those managers cannot necessarily make all the decisions in the company. If it was a one or two people company, maybe there is enough time, but the larger the company, the less time they have to do it. So they ultimately need to start delegating decisions to others. And here is where the more important part comes. How do I design those controls and the incentive system, like compensation structure, bonuses, etc., that are going to ensure that those constituents to whom I delegate the decision making, are going to make the right decisions. So all this is going to ensure that truthful reporting is not an exception, it's more the natural choice that is in the company. See, now, how does my financial accounting class differ? Well, it actually turns the lens upside down from a different perspective. So, whereas in managerial accounting, we were looking at what brings to those decisions and how to change those decisions, we're now looking at the outcome of these accounting choices and decisions. And what I do tell students is, well, it's almost like you need to anticipate what brought to those decisions. Try to put yourself into the shoes of the manager who made those decisions and be critical. And I very often laugh that essentially my classroom sometimes in financial accounting turns around and becomes like a courtroom because we have the management making their case and we have the document, which is what they have submitted to us, financial reports, for example. And then we've got the auditors asking the questions, maybe me. And then we have the investors, who are the students, trying to figure out what the truth about the company is. So I would say, if I have to summarize everything I said, the best lesson is to think about the uncertainty, prepare very well about it, and just make the decision. I try to teach my students that real expertise is not always knowing and making the best decisions. You're ultimately going to make bad decisions on the way, but knowing that you can do as much good as possible and be prepared for everything. And at the end of the day, even though there is uncertainty, you need to make that choice. So I think that's the biggest lesson I took personally.
Professor, can you share a moment from your legal career that directly influenced a research question or project in accounting?
Hmm. I think there was not a specific moment that I can pinpoint in my career. It's more those small experiences and realizations over different cases that led me to believe that, well, sometimes you look at numbers and facts more broadly, but let's talk more about numbers, accounting, and white collar crimes. That's more precisely that. And you realize this it is all compliant, right? You as you would expect, and yet the whole picture is somewhat misrepresented, it doesn't sit right, right? So it's those small decisions, as I said, maybe the context or the timing of the decision that you're making, or perhaps the choices that different small accounting choices that lead to the outcome that are somewhat off. Um, so that, in a nutshell, shaped how I think about reporting in general and accounting more even more general. Um, so I really always ask myself, what was it that brought to those choices? So if I think a little bit more deeply, um, it is very often how how we do design those choices. And I think it is more the answer is into the prevention of those choices rather than reacting when everything has been done. And I think academia really gave me this option to do it.
Professor, how does your legal training inform the way you design analytical models in your research on disclosure and incentives?
Yeah, I think, and I have had this question several times in different versions, and people say, okay, but law is very different than economic models, and how do you even reconcile those two? And I actually think there is a lot more in common than people realize. So what legal training teaches you is precise logic and be very impeccable and precise. I mean, thinking one thing after another. So when you're writing a legal document, you often start by laying out all the facts in a very clear manner. And then what you follow up with is making your point and your case in a very logical way. So this is precisely the way I actually approach economic modeling. First, to be precise, even when I'm building the model, I try to favor simplicity over complexity. So you can, of course, take the real world and put everything in your model, but then it becomes a big salad and you cannot understand what are the driving forces. So I strive to make as clean as possible models that are going to convey what I want to convey, the economic forces that I'm interested in. And then, so once I lie the model, I very meticulously explain and defend why I think those are reasonable assumptions of the model, and then naturally follow the outcomes. And then this brings to very often to unintended consequences, which later on might essentially go into the courtroom. But that for the moment, I'm less concerned about while writing a model. One other thing I really, in a sense, my legal practice and experience is informing is when I prepare for a presentation of my work. Let's say 2 weeks ago, I was presenting my research at Bocconi. So you go and you think and try to anticipate all the possible questions and how are you going to address it. It's really very, very similar to what one might think law is, right? So I really think the two are very connected, and it's really helping me, actually, my legal experience. I might not write court documents. I may not appear in court, but my every presentation is like a mini appearance in court. Every teaching is like mini appearance of court. And maybe those courts are even more critical in many ways.
Professor, in your view, what are the most common blind spots executive have when it comes to ethical financial reporting?
Mhm. Um, well, I think the biggest one that I really want to start with is short-termism. So very often managers are thinking, okay, there is this small tweak that I can make today in order to make things look better. Um, and sometimes this is even within the legal bounds that are allowed to companies. But they don't realize that that small decision today, in order to keep this coming and it doesn't get reversed and worse, next period, next year, next quarter, you need to do a little more. And then the year after, a little more. And very quickly, this snowballs. So our small decisions today are going to influence a lot tomorrow, but managers very often are focused on today. Now, one big problem for that is how we as economists, as well as companies and the shareholders of those companies, design the incentives. Those incentives essentially incentivize this short-term thinking. Very often, those managers, I mean, on average, there is research showing that on average, those managers stay for 3 years with the company. So, how do we incentivize managers to make those decisions today, even though they're very myopic and their horizon is short, even though their outcomes, their actions are going to stay with the company for so long? So I think this is a really critical point. Forget this short-termism, focus on the long run. Another blind spot, perhaps, is that, well, managers often think that compliance and ethics are the same thing. But I think ethics is much larger. You can be completely compliant and yet some of your choices not be perfectly ethical. So being ethical is a higher bar. And complying with that higher bar over time is going to essentially build the credibility for the company in the long run, which is going to pay off very big time with investors. Um, I think another blind spot is to never forget that humans not always behave rational, and keep an eye on that. So we may want to have some feedback from behavioral economists about certain outcomes, certain biases that need to be overcome. There are economic biases that we are all aware, but very often we forget that.
Professor, how do you help MBA students critically assess corporate practices and challenge assumptions about financial statements?
Sorry, can you go back?
Yeah. How do you help MBA students critically assess corporate practices and challenge assumptions about financial statements?
Oh, Uh, well, I tell my students always to try to be financial detectives. Like, you look at a company, we look together on those numbers very often, and well, we are we you the numbers may look, all of them, compliant and make sense and even build a picture of a prospering company, and yet once you dive into the accounting practices, you read the small letters, something feels off. You come to realize that all those accounting choices over the way, they essentially built and made a lot of changes. Now, and made changes in a way that matters, right, for the long run of the company. So I really teach them to think about the managers, the agents who made those choices, what kind of uncertainty, what kind of constraints and incentives they were facing, and try to figure out, compared to other companies, but perhaps, I mean, I really don't want my my students to be cynical, right? But on the other hand, I want them to be discerning, to be critical, and not just accept what they see as given.
Have you observed differences in how low-trained versus business-trained students approach issues of transparency and accountability?
Oh yeah, it's actually really entertaining to see this in a classroom. So let me start by the fact that, of course, I have all those students in the classroom, both people who come from law, people who come from business. I do also have people coming from, I don't know, geography, biology, engineering. So it's kind of an eclectic combination. But let's focus on the law and business students oriented. First of all, I always make lawyers jokes. So I usually make one or two, and then I ask, is there somebody who comes from law? And I always laughs afterwards and joke that here goes all my lawyers' jokes because I can laugh about myself. I cannot laugh about them. So, but it usually this is what it boils. And now looking at those law students, we are trained into thinking in terms of boundaries, legal versus illegal, compliant versus non-compliant. And when you think about business students, I mean, though they usually think about, okay, or economic students more broadly, um, what is the optimal decision, whether it is effective, how is it going to influence? So when you put those two types in one classroom, they feed each other, like essentially they complement each other. But the combination is really eclectic. One brings the boundaries, and the other side brings the optimization, the making it better, the innovation. So it's really fascinating to watch it.
Professor, what role do you see interdisciplinary knowledge combining law and accounting playing in shaping corporate governance practices?
Mm. Yeah, I think the role is very central. So when you take a step back and think about corporate governance, it lies in the intersection of several disciplines: law, economics, accounting, behavioral economy, even data science, right? So all those come together. And I really feel that on the one hand, for example, when I think about my research, um, let's say when I'm looking at corporate boards and their decisions, the outcomes, the incentives that we give them, I start with this, with the facts, some legal obligation that they have to fulfill, let's say fiduciary duty. But then my economic models is going to look within those boundaries how this behavior is being shaped and incentivized. Um, so I really think it is critical precisely in those areas that we combine all the knowledge that we know. Of course, behavioral economists are going to tell us that people don't act always rational and gonna teach us about how all those. Accounting is also going to give us some kind of boundaries on behavior. So all those are going to create are work together in order to provide the real benefit, the real contribution to society.
Dr. Micheli, how has your journey from prosecution to academia influenced your advice to regulators or
Mm.
firms regarding financial disclosures?
Uh, yes, it's so when if there is one very important lesson that I learned from my experience and my research is not to take simple answers for granted. Avoid simple answers. Now, in law, I kept on thinking, okay, if there is more regulation and we require more information that companies disclose, so in other words, more disclosure, mandatory for, then things will be better. But my research has taught me that essentially requiring more may actually alter the incentives of individuals and firms, more importantly, in a way that they're going to end up disclosing less information and less of that information that investors are so interested in finding. So my advice is don't simply think about requiring more and regulating more and asking for more disclosure, because this can have a very important unintended consequence behind it. So we really need to be thinking deep when we are making those decisions about regulations. What can go wrong? And I really think that regulators should invite more academic researchers, more economists, and discuss with and accountants, which we are applied economists in a sense, thinking deep together of what can go wrong. Have a round table and discuss openly what can go wrong. Here's the regulation that I want to come up with. Don't let us years afterwards come and try to figure out, after you have already implemented it, after companies, the damage has been done, because sometimes those damages, those choices are sticky over time, right? Even if you reverse the regulation, it will take time until things change. And in essence, really, we really need to be vigilant. Let's say one of my papers looks at unintended consequences of Reg FD, Regulation Fair Disclosure, which required everyone to disclose publicly. And I really show that eventually companies this will be like a cold shower to the companies. They're going to choose less of an information. On the other hand, we need to be also vigilant that different incentives may actually shape all those choices together. So yes, requiring a lot of disclosure needs to be together with how firms are going to shape those incentives. So I have this case of very recent case, I mean years, but still recent, of Wells Fargo. I don't know if you remember this story where, well, individuals responded to the incentive. So the company was facing a lot of pressure and was trying to respond to Wall Street, to investors' requirements within the framework of regulations. So they came up with those short-term decisions and short-term incentive scheme, which ultimately led to people making the wrong choices. And again, we required something more, but then we ended up with essentially this was a misconduct, right? So it kind of made a big circle and it turned to the worst decision out there.
Professor, I would like to conclude this episode with one last question. Looking back, what advice would you give to someone considering a transition from law into business academia?
I think it's going to be very important to essentially be prepared and be ready for this transition. You see, when I go back to my experience, I endured a lot, right? Because it was not only a new beginning, fine, that we're all excited about it, but it involved moving to another country, giving up a job where I was already earning, etc. So moving to a completely new environment where you are not earning, you're again a student, you go back to the student bench. You socially have to adapt to a new environment. And not only that, that's perhaps the more social side and economic insight, but you also need to learn entirely new tools, right? Game theory, apply this, but math, a lot of new math skills, So that's really the big difference between law and economic research. And it humbles. It's a humbling experience. And it may seem at the beginning that there is no connection between your past and your future, and all these years in law, in this case, you're essentially losing, but you will feel disconnected at the beginning. But as time goes, you're going to see the connection between them, what your past has taught you about what you currently do and how they inform each other. And when you do, it's really going to inform better your research, your teaching, your new area. I mean, I'm thinking a little bit more broadly than just transitioning from law to academia or law to economics. But I mean, it probably is true for every area out there.
Listeners, we are grateful to Dr. Beatrice Michaeli for sharing her unique journey from law and white-collar crime prosecution to accounting academia. Her insights into financial reporting, disclosure, and teaching future business leaders to question corporate practices offer a rare and valuable perspective. We hope today's conversation inspires our listeners to think critically about transparency, ethics, and intersection of law and business in their own careers. Thank you again, Dr. Michaeli, for joining us and generously sharing your insights and experiences with our audience. We truly appreciate your time and commitment. Thank you.
Thank you very much, Deepak. It was an immense pleasure speaking with you and with your audience. Thank you.
Thank you.